Quality signaling is the way in which companies, individuals, or organizations communicate the quality of a product or service when that quality cannot be directly observed by the buyer. In simple words, it is how sellers give signals that their product is good, especially in markets where buyers cannot immediately test or measure quality before making a purchase. The concept comes from information economics, a branch of economics that studies situations where one party has more information than the other. The idea was made famous by the American economist Michael Spence, who in the 1970s introduced the concept of signaling in the labor market. He later received the Nobel Prize in economics for this work. Historically, quality signaling arose as a solution to what economists call the problem of asymmetric information. When buyers cannot tell the difference between a high-quality and a low-quality product, they may be unwilling to pay a high price, which can push good products out of the market. This was well explained in George Akerlof's famous article, The Market for Lemons. Signaling is one way to fix this problem, because it allows sellers of high-quality goods to communicate that quality in a credible way. A signal is only effective if it is costly or difficult for low-quality sellers to imitate. In other words, the signal must separate the high quality from the low quality. For example, in the labor market, a university degree can act as a signal of ability and dedication. The reasoning is that earning a degree requires effort, time, and resources, so it is more likely that productive and capable individuals will obtain it. In product markets, there are many forms of quality signaling. Advertising is a classic example. Spending large amounts on advertising can be a signal that a company believes in the quality of its product, since only a product that will sell well can justify such costs. Another example is offering long warranties. A company that gives a 10-year warranty is signaling that its product is unlikely to break, because otherwise, the warranty would be too expensive. Brand reputation also works as a signal. Consumers trust certain brands because those brands have invested for years in maintaining quality. Think about luxury brands. Part of their value comes not only from the actual quality of the product, but also from the reputation that signals that quality. There are also more subtle signals. For instance, a restaurant with a long waiting line outside is signaling popularity, and indirectly, good quality. A wine bottle with expensive packaging signals premium quality, even if the buyer has not tasted it yet. In many markets, higher prices themselves can act as a signal, because it suggests that the producer is confident that customers will still buy the product. Of course, signaling has its limits. Some signals may be misleading. For example, a company can spend money on advertising for a poor quality product, but if customers discover the truth quickly, the signal loses credibility. For this reason, effective signals must be sustainable in the long run. One interesting curiosity is that economists distinguish between signaling and screening. Signaling is when the informed party, like the seller, takes action to show quality. Screening is when the uninformed party, like the buyer, designs mechanisms to uncover the truth. For example, an employer might offer a pay structure that rewards performance, which screens for high-quality workers. Another curiosity is that signaling theory has spread far beyond economics. It is used in biology to explain how animals signal their fitness to potential mates, in politics to explain how governments signal strength to rivals, and even in daily life, such as when people wear certain clothes, buy certain cars, or use certain brands to signal social status. To summarize, quality signaling is a fundamental idea in economics that explains how high-quality sellers can stand out in markets where buyers cannot directly see quality. It reduces the problem of asymmetric information, helps build trust, and allows markets to function more efficiently. Without signals, many markets would collapse because buyers would fear being cheated. Above, I leave you more videos so you can continue learning law. Remember to give us a like and subscribe.